My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make some money. My job is not just to entertain, but to educate and put this in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. This, my friends, is an entirely manic, depressive market. Sell. There's a widespread belief that everything's great. Buy. Or everything's terrible.
A house of pain.
Zero middle ground, which means we're either poised for an amazing run higher or we'll get hit with that fabled 10% correction, if not more. Remember, we haven't had a 5% correction in 10 months. After another ugly day, though, with the Dow losing 383 points, S&P shedding 1.07%, NASDAQ declining 0.89%, this logic is incredibly seductive, isn't it? Because it justifies the extreme negative view. If the Delta variant can't be stopped, then we're living in serious times, times that will freeze economic activity and put an end to the amazing boom in service, in leisure, in travel. Those are all the key pillars of the great reopening. Knock them down. That spells the end of everything from Boeing's nascent rally to the airlines' attempts to get back into the black, to the hotels, restaurants, and small retailers that had been roaring as part of the great reopening trade. But this, and this is one important but, if the Delta variant can be tamed, something that Dr. Scott Gottlieb, the former head of the FDA, now a CNBC contributor who must all you ever meet of people who believe in this guy, thinks could happen as soon as this weekend, then all the stocks you'd be selling under the doomsday scenario, they would have to be bought right back. If Delta peaks, you'll be thanking your lucky stars that you didn't listen to the myriad bears who keep mauling the reopening stocks. There's just one problem with this analysis, though. See, nothing in this world, especially stocks, is ever black and white. Wall Streeters act like this is an either-or moment, either a disaster scenario or a heaven-sent bull run. But what if the reality is somewhere in between? For example, tonight we'll be talking to Marvin Ellison, the CEO of Lowe's, whose stock tumbled from 193 to 182 yesterday. Why? In sympathy with the decline in Home Depot. Then this morning, the company reported an excellent quarter, and the stock jumped $17. Why? Because Lowe's is not Home Depot. They're in better shape. The chain is in a major transformation. Localizing its stores, making them more friendly to professional contractors. That's a market that had been previously dominated by Home Depot. Lowe's is also trying to win back female consumers who had been their core demographic until a few years ago, before Marvin was there, when the company really did lose its way. So is Home Depot living the disaster scenario while Lowe's exists in an alternate universe where everything's fine? Of course not. The doomsday or delight rap makes for a great story, but in the end, it is a tale told by an idiot full of sound and fury, signifying nothing. My advice to you, resist this bogus all or nothing analysis. It just doesn't work. Wall Street always seems to embrace these false dichotomies, doesn't it? They embrace them because most commentators place way too much emphasis on big aggregate numbers that are spoon-fed to them from the government because they're so easy. It's like, open my mouth, See, what they do is they try to bolster the case by looking for convincing anecdotes. Other than that, they don't particularly care about what individual companies have to say. You know why? I'll tell you why. Because you weren't up with me at 3:30 in the morning doing it. You know what? It's too time-consuming for them, it's too tiresome, it's too granular, and it does not go with G&Ts. Yesterday, for example, we learned that U.S. retail sales were very light in July, and we didn't know what to make of it. Then Home Depot comes along with a perfect swing and a miss anecdote, talking about how do-it-yourself shoppers slowed down their spending because they wanted to spend their money on something other than renovations after the great reopening got rolling. Well, that made Wall Street suspicious of every retailer, even the good ones like Walmart, and the whole group got pummeled. Today, though, Lowe's and TJX both told terrific stories. They really make you question the usefulness of that aggregate retail sales number that comes out of the government. It might help an economist cook up a theoretical forecast so that maybe they can teach a really good class that you and I can cut. But in real life, it makes you no money. We saw the same things in the autos. We heard about general weakness in the industry associated with that ugly retail sales number. But what if I told you there are more semiconductors around these days, which allows the automakers to produce new cars, meaning the fall buying season could be fantastic? You still want to sell the auto stocks down here? As I told my favorite Scott Wapner during my regular halftime gig, Ford Motor just tumbled from 16 to 13, even as the chip shortage is easing up. Remember, this is a guy who wants to bury Elon Musk. You think he's happy about his stock going from 16 to 13? You think this is funny? No. All right, anyway, we got a similar story today. This time, the horrendous aggregate news came in the form of slowing home sales numbers, largely due to sticker shock. Home prices have gone up radically, in part due to commodity inflation, but mostly because we've got a housing shortage. Now we're being told that the Fed needs to take action to cool down the housing market because prices are so high and mortgage rates are so low. I read it the exact opposite way. I think the boom is far from over. COVID originally drove an insane housing frenzy as people fled the cities for more spacious homes in the suburbs or the country. Totally unsustainable. Now, though, I think that frenzy may be settling down. You know what? That's good news for the industry and the stocks. Now, this slowdown had been widely anticipated. The home builders wanted to take this moment to replenish their supply. One supposedly bad month does not demolish the totally bullish scenario of low mortgage rates, strong demographics. You know, you've got 75 million millennials who are increasingly starting families, not to mention low supply and 10 years of pent-up demand. All that said, there are plenty of people worried about the biggest intangible out there, one that's weighing on the entire market. Where the heck are we going to be going to work in the fall? Let's say if you live near the center city of Philadelphia, let's say you live in Manhattan, and your business moves out to the suburbs. It's something that may require substantial interaction on a subway or bus. You could be buying a car. Or you move out to the suburbs because you don't want to be able to, you can telecommute for 3 days a week. Well, again, you don't know what to do. Do you go back? Do you stay? Is hybrid still on? But if you don't know what's going to happen, which is the case for millions of Americans right now, trying to figure out the new hybrid work style, it may freeze you into not buying anything. Let's face it. If you are going back to the office after buying a place further away, you won't be throwing a lot of money at your new house. So what can you do about this moment to make sure that you don't get blown out by a tougher market? How do you thread the needle if it's true that COVID cases really could peak on Saturday? Something that would be fantastic for the stock market and, of course, the country. If you think we are still on the verge of starting to beat the Delta variant, which many people I talk to today think is true, then it's real easy. You buy some Walt Disney, which is now $5 below where it was when it reported strong earnings last Thursday. If there's a lockdown, they've got Disney Plus. If people are still willing to socialize outside, they've got the theme parks. If it's a full reopening situation, they've got movie theaters. They even have cruise ships. The good news here, every single time the market takes its cue from an ugly aggregate number, and with the exception of the hugely important non-farm payroll number, which actually is meaningful, you should have an outlier stock that could be worth buying into weakness. It's called your shopping list. The bad news, you still get days like today where it simply doesn't matter and nearly everything drifts down. This is day 2 of a larger sell-off. All I ask is that as the market gets more hideous, you get more interested in buying something. The bottom line, like every other sell-off that's tried to decapitate the bull and bring you its head on a silver platter, this pullback won't let you make a ton of money immediately. But I think you'll get some great entry points that could set you up for tremendous long-term gains when people realize that Delta is not the end of the world and will end.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.